Let's begin by zooming in on what the market is expecting from this week's Fed meeting. As of now, the futures market is assigning just a 7% probability of an interest rate cut. That number tells us something important. Wall Street is betting almost entirely on no change. In short, the consensus is clear: Powell will hold steady. But just because markets are calm doesn't mean the political pressure has disappeared. In fact, it's quite the opposite. President Donald Trump has been vocal once again, urging the Fed to lower interest rates. He argues it's the only way to protect the U.S. economy from the growing impact of tariffs and rising import costs. However, even as he turns up the heat publicly, something changed behind closed doors. Trump recently made an important statement. He said he has no plans to remove Fed Chair Jerome Powell. That one line may have done more to stabilize financial markets than any rate cut could. After weeks of uncertainty, bond markets breathed a sigh of relief, and yields dropped nearly 20 basis points. Still, the underlying tension remains. This week's FOMC meeting isn't just about interest rates, it's also about credibility, independence, and the Fed sending a message. Powell now stands at a critical crossroads. On one side, political pressure demanding faster action. On the other, a responsibility to remain data-driven and independent. This meeting is an opportunity for the Fed to make that position crystal clear, that they don't respond to headlines or tweets, they respond to evidence and economic fundamentals. So as markets watch closely for hints, don't just look at the rate decision. Listen carefully to the language, the tone, and the message behind the pause. Because sometimes, not cutting is the most powerful signal of all. Now let's dive into the economic data, the real engine behind Fed decisions. And this past quarter, the headline number grabbed attention fast. U.S. GDP contracted by 0.3% in the first quarter of 2025. That's right, the U.S. economy shrank for the first time in 3 years. And many headlines ran with this, warning of a slowdown or even a looming recession. But there's more beneath the surface. This contraction wasn't driven by collapsing consumer demand. Instead, it was largely caused by a sharp spike in imports. Here's what happened. Businesses were front-loading, meaning they rushed to import goods ahead of expected tariff hikes. That flooded the trade balance with short-term imports, making GDP look worse than it actually was. So what happens when you strip that out? You'll find that domestic demand was still strong. Services spending held up. Non-durable goods continued to see steady growth. It was only durable goods like appliances or cars that showed a meaningful dip. The inventory buildup also offset some of the damage from net exports. So while the headline figure was negative, the core economic trend remained relatively stable. Now let's look at inflation and labor costs. Two things the Fed watches like a hawk. The quarterly PCE inflation and the employment cost index both surprised to the upside. That means, despite economic softness, inflationary pressure hasn't cooled off yet. In fact, the cost of core services began rising again in late March. That's a red flag for the Fed because it suggests that sticky inflation is not going away quietly. So here's the big takeaway. GDP may have dipped, but the underlying data tells a much more complicated story. Demand is steady, inflation remains sticky, and that gives Powell and the Fed reason to hold rates steady. Not to panic, not yet. Let's now talk about the labor market, arguably the most emotionally charged and politically sensitive piece of economic data the Fed watches. Why? Because jobs mean stability. Jobs mean consumer spending, and jobs mean votes. But right now, the labor market is sending mixed signals. Let's start with the ADP employment report. For April, the private sector added just 62,000 jobs. That's barely half of what analysts expected, and the weakest reading since July of last year. That number might seem like just a blip, but it could be the first sign that tariffs and rising input costs are finally starting to bite. Companies are feeling squeezed. Raw materials are more expensive. Demand is getting patchier, and so hiring freezes are creeping in. But ADP is just one piece of the puzzle. The JOLTS report, that's the Job Openings and Labor Turnover Survey, tells a broader story. In March, job openings fell to 7.2 million, down from 7.5 million expected. That's a clear sign that businesses are pulling back on future hiring plans. But here's the twist. It's not all bad. Hiring actually picked up slightly, and involuntary layoffs went down. So while companies are being cautious, they're not panicking. Not yet. Now let's talk about what Americans are feeling. The Conference Board's Consumer Confidence Index fell again in April, the 5th straight month of decline. And it wasn't just a general drop. It came from the expectations component, which tracks how people feel about the future. More Americans now say, jobs are getting harder to find. Inflation is a concern. Plans for big-ticket items like cars, homes, and holidays are on hold. In other words, people aren't seeing a crisis, but they're definitely pulling back. This kind of sentiment change is often a leading indicator for broader economic softness. So what does this mean for the Fed? It means the labor market is slowing, but in a controlled and uneven way. There's no crash, no major spike in unemployment, and no recession panic, yet. That gives the Fed room to wait. They'll acknowledge the slowdown. But with inflation still hovering high, they're unlikely to act unless these job figures get significantly worse. So for now, the Fed is likely thinking, yes, things are softening, but not enough to justify a move. Not yet. Now let's turn to the second half of the Fed's dual mandate, and arguably the stickier problem right now, inflation. You've seen the headlines, you've felt it at the supermarket, the gas station, and probably in your rent. Inflation isn't falling as fast as many hoped. Despite a softening job market and slowing GDP growth, the cost of living continues to grind higher, especially in core services. Let's talk numbers. In Q1, the Employment Cost Index came in above expectations. That means wages, benefits, and labor-related costs are still rising. So, while the economy is clearly slowing in parts, prices are proving resilient, especially in sectors like housing, healthcare, and insurance. And that puts Powell and the Fed in a tricky position. If they cut rates too soon, they risk undoing progress made on inflation. Lower borrowing costs could fuel new demand, which might send prices even higher. This is the dilemma. The labor market is starting to weaken, yes, but inflation is still too sticky to ignore. Cutting rates now might offer short-term relief, but it could lead to long-term pain if inflation expectations become unanchored again. And Powell knows this. In recent speeches, he's made it clear. The Fed isn't just looking at job numbers. They're focused on price stability, and they want clear, consistent disinflation before making a move. So where does that leave us? Even if the job market weakens more in the coming months, the Fed might not respond immediately, not unless inflation gives them room to do so. Until then, the Fed is likely to stand firm, signal patience, and wait for both pillars of its mandate, employment and price stability, to align. Because one without the other isn't enough to justify a rate cut. So where does all of this leave the Federal Reserve and the markets watching its every move? We've looked at the numbers. GDP contracted, but mainly due to front-loaded imports. The labor market is softening, yet still intact. And inflation, especially in core services, remains stubbornly high. Together, these data points paint a picture that's not entirely bearish, but far from comfortable. It's a crossroads moment. Growth is cooling, hiring is slowing, but inflation hasn't cooled enough for the Fed to feel safe easing policy. That's why I believe the Fed, under Jerome Powell, will hold rates steady at the May 2025 meeting. Not because everything is fine, but because the risks of acting too soon still outweigh the risks of waiting a little longer. In the background, tariffs are reshaping global trade, consumers are tightening wallets, and the political pressure is ramping up. But Powell and the FOMC aren't here to respond to headlines. They're here to keep inflation in check while avoiding a deep recession. And for now, that means one thing: pause, reassess, and wait for clearer signals. Now here's my final take. The Fed knows its dual mandate, maximum employment and price stability, is being pulled in two different directions. But until inflation convincingly cools or the job market breaks down more sharply, Powell will likely hold the line. We're in a phase where patience is the playbook. And while markets may want action, Powell is looking for confirmation, not speculation. So as we move toward June and July, all eyes will remain locked on incoming data, because that data will write the next chapter. Thanks for watching. If you found this breakdown helpful, give it a like, leave your take in the comments, and hit that bell so you never miss a shift in global markets. See you in the next update.